Hey everybody, welcome to today's video. We're going to be talking about your complete guide to RRSP investing. I hope you love it. I'm really thrilled to be able to have this under the playlist of my YouTube channel. It's going to be useful for the novice investor all the way up to someone who is an expert or an advanced investor. So decide on which video might be most appropriate for you. But in each of the videos, there's actually going to be some things that I'm sure you weren't aware of, and you're going to rethink how you should be using your RRSP. And so that's the benefit of watching every video. To those who are new to the channel, my name is David Aaron of Aaron Wealth Management. I provide educational videos on investing, life insurance, retirement planning, estate planning for business owners, individuals, and families. And yes, I'm an active advisor. People will ask me this question, do you just do educational videos? No, actually, I'm an advisor, and I have clients right across Canada helping them with all of their investment challenges. And so I look forward to hearing from you. If you have any questions, put those in the comments below or contact me via email or on the telephone. Let's get into the first video. I hope you like this. So an RRSP was started by the government of Canada. When it was started isn't really irrelevant. It doesn't help you retire. But what is relevant is that the government recognized that they needed to help Canadians save for retirement so that they weren't using government benefits or as much government benefits as possible. When we say government benefits, right? Canada Pension Plan, Old Age Security. And so they wanted to encourage people to start saving. So they came up with a plan that said, well, let's encourage people to put money into an RRSP, and when they do that, they're going to get a tax break for doing it, and we're going to let them grow their money inside of an RRSP, and we're not going to tax them when they make money in the RRSP. We'll just tax them when they take it out. That's basically an RRSP in a nutshell. So if you hit stop right now, that's all you'd need to know. Not really, but there's some really important information for you to understand. So I'm going to go into sort of like the theory behind it and understanding how useful it is for you. And then the next video, we're going to go into setting up an RRSP. So basically this is going to be like if you and I were sitting down across from a table and you said, David, I'm not sure, I heard about RRSPs, but I'm not sure if that is the right type of investment account for me. Can you help me to understand? That's what this video series is really about. It's going to teach you exactly what an RRSP is. An RRSP is perfect because it solves two of your problems right away. One is you're earning an income, and as your income goes up, you're going to pay income tax on your earnings. So you'd say, isn't there a way that I could pay less income tax? An RRSP, and I'm going to show you exactly how that works. And the second is, well, you'd like to start a retirement savings plan so you can retire with more money and have a great retirement. So those two concerns are solved by using one product. So that's a pretty good product when it can be used to solve more than one. So let's take like an example of this, okay? Imagine you are earning $70,000 per year and you say, I'd like to start a savings. How much money can I put in an RRSP? Well, it's 18% of your earned income. You can also find it on your notice of assessment. It'll say your unused contribution room, and it goes into a bunch of areas of saying how much you can contribute this year, what unused contribution room do you have. All that's found on your notice of assessment. But essentially, let's assume that you've never made an RRSP, you've never had T4 income, this is your first year T4 income, and you made $70,000. The maximum you can put in is 18% of your earned income, which is $12,600. So that money gets deposited to your RRSP, and then when you go to file your income tax, and the government says, well, you made $70,000 and we taxed you at $70,000, you can then say, well, wait a minute, I also deposited $12,600. So only tax me on $57,400. So you see, that's where your return comes, among other things, other different tax credits. But let's just talk about RRSP. So that difference, your tax return is the difference between the $70,000 and the $57,400. And that's where you would get money back on your return. So that's how you can save money on employment earnings. So it's a simple thing. Two concerns are solved with just one product. Now the money, that $12,600, goes into an investment account, which is your RRSP. You choose what kind of investments. That's covered in another video, so you'll see that, I think video number 4. and you make money on that, so it grows, okay? So let's say that $12,600 goes to $15,000. Well, you don't pay any income tax on that growth, but you do pay income tax when you go to take it out, and that's covered on the contributions and withdrawals. So you're earning an income tax, you're earning money through your employment earnings, and you're saving money using your RSP. That's kind of like the basic understanding of what an RSP will do for you. Now, why do we call it tax deferred? I just want to go into this a little bit in more detail. Tax deferred means, or a tax advantage fund, means while you have your money invested inside of your RSP, the government is not going to tax you on its growth. They're going to defer taxing you. That's why they call it tax deferred. They're going to defer taxing you until such time as you make a withdrawal. So either a withdrawal saying, please take out $10,000 for me, or if you convert your RSP into what's called a RIF, a Registered Retirement Income Fund. And this is the stage of investing where you're now converting your accumulation of your RSP into an income stream. And that's called a Registered Retirement Income Fund. And then that's when you would be taxed as you take money out of the income fund. So essentially, when you go to the RIF and you take money out monthly or annually, they would subtract tax from that income stream. Okay, so you would, depending on what your marginal tax rate is at the time, this is how much tax would be taken off of your investment, and the rest would be deposited to your checking account. It's pretty simple, straightforward. That's how that works. If you do a withdrawal, like just a straight withdrawal out of the RSP, this is going to incur what's called a withholding tax. And the government, I'll put the table up here on the screen for you so you can see the withholding tax. This will be your financial institution immediately taking out a withholding tax and sending that to Revenue Canada on your behalf. So it's not a surprise at the end of the year. And that's basically how that works. So there's a withholding tax before retirement, and then there's just your income tax that comes off of it when you convert it to a RIF. And that is that's your retirement income, right? Along with your Government of Canada benefits, Canada Pension Plan, Old Age Security, your tax-free savings account, and any RIF income, and any other sources of retirement income. That would be your retirement income. So there's a theory behind why someone uses an RSP. Let's say in that case of that $70,000 or $100,000 income, employment income, you're at a higher tax bracket, right? You don't like it. Nobody likes to be taxed a lot of money, but you're making a contribution and you're getting back at your marginal tax rate through your tax return. And then when you retire, the theory behind it is that you're going to be in a lower tax bracket, and hence you're going to pay less tax on the way out. So you get a higher tax bracket depositing and a lower tax incurring lower tax as you take it out. That's the theory, and for most Canadian it is like that. But what happens if you actually have other assets that are producing a taxable income that creates, either you get more money than your employment earnings, then it really wasn't a tax savings from a point of it going in and coming out. It didn't really help you. What did help you was the tax deferral part of using what would have been money you sent to Revenue Canada. You use that and you grew your money with that. So here's a quick review. This is why you want to be able to save on taxes, because high income earning, this is getting crushed, punched in the face with the Revenue Canada income tax. We want to save you from that. So let's look at the different tax that you pay in Canada, federal and provincial. When you combine those two tax rates, that's called your marginal tax rate. And people say, well, I'm taxed at 50%. Not on every dollar. It's actually a graduated income tax table. So let's look at this. The first $50,197 of earned income goes at 15% tax rate. This is your federal income tax. Then your next $50,195 is taxed at 20.5%. And then your next $50,233 is taxed at 26%. So you see how this goes. So cumulative, if you had reached $100,000, you are being taxed 20.5% on $50,195, And then the first 50,197, you were taxed at 15%. So you see how that works? But let's look at the combined federal, provincial, and income tax table. And you'll see in the link below, there's a link to the website that has all these tax tables. So if you were to earn, let's say, $150,000, then you would have, do you see where this is the marginal tax rate? This is the columns we're paying attention to. All the other ones are for different sources of income. But if you were, let's say, the $150,000 income level, if you move to the right under the marginal tax, it says 44.97. So that's the amount of tax you would pay if you reach that level. So if we examine why is this table helpful for you, because it helps you understand how much income tax you are going to get back if you make an RSP contribution. Now, there's actually calculators online that I'll link you to so you can go ahead and figure that out. In fact, I actually have one on my website, so I'll put that link in there for you. But if you did a $10,000 contribution and you're in a 48.35% marginal tax bracket, you would get back $4,835. That's how RSPs work. So it helps you to lower your income tax. So that is sort of an understanding in the first video of what is the purpose of an RSP, the benefit of it. And now we're going to go into the next video of how to open up and set up an RSP. And it's going to appear to you that I'm talking to you like you're just opening an RSP, and I'm walking you through an application and explaining what is the benefit of each section, why you're being asked these questions. And there might be some areas that you didn't realize that you should have been doing when you first started your RSP. So pay attention as we go through those sections. Thanks again for joining me on this video. Again, if you like this video, share it with anybody you think needs to see it. Please like and follow. And I love your comments, and I look forward to seeing you in the next video. Thanks very much. Take care.